Seller Financing 101 Explained. On this video, I thought it would be great to talk about owner financing. We are seeing an uptick in owner financing transactions in the market. It's really created a win-win for buyers and sellers. So this video is really going out to our sellers that are watching this video. Maybe you're not a seller yet. Maybe you're an owner and chances are built up a tremendous amount of equity in your multifamily property, or possibly it's free and clear and you're enjoying those cash flow checks monthly. Now, a lot of owners would like to sell, but they don't want to pay a bunch in tax, and I totally understand that. So a lot of owners will then, when they're ready to divest, will 1031 exchange. Well, this video is for folks that don't want a 1031 exchange. You've already ruled out, you don't want to go into another multifamily asset. You like the asset you're in, you don't want to buy another one, get comfortable with a new building, deal with property management. But you want to structure it to where you can get a great sale and then also receive monthly income after the sale. And this is when you become the lender and you carry the financing for the buyer. So let's go through, we're going to talk about a live example later in this video, but diving in, let's talk about what is seller financing. So the seller and buyer really agree on the main deal points, right? The purchase price, the down payment, the interest rate, the term of the loan, and when the loan is due. You are now a lender, so it's not just a transaction and then the buyer and seller go their separate ways. You want to make sure as a seller that the buyer does well with your property because you are the lender. At the end of the term is called the balloon. That's when the final loan balance is then due. And at that end of that term, the buyer's either going to sell the property, refinance the property, or pay the loan off. So that's really how this whole thing comes to an end. And typically the terms are anywhere from 3 to 5 years. They're totally negotiable. You could go shorter or longer, but typically we see about 3 to 5 year seller carry terms. And you get interest only payments is what we see as most common because it's very easy to calculate the math on that. You get interest-only payments on the loan amount for the duration of the loan. So if it's for 5 years, you get 60 payments. You get one payment every month, get a great stream of cash flow, and then you also have the down payment front end. Once the property closes, you get the down payment. So you're getting cash in multiple ways. You get it right at the sale, you get the down payment, you get the streams of cash flow monthly, and then you get the lump sum balloon at the end. So I kind of wanted to make sure that you really understand, in short, you're the bank. And we want to make sure that this is really for people that don't have a high need for the cash. They want to kind of simplify and then also possibly mitigate their taxes. So whenever we help evaluate selling a multifamily property for an owner, and if they have a lot of equity or it's free and clear, we discuss owner financing to them because interest rates are higher now, so people can actually make a good cash flow stream. So this is when we would roll up and have them talk the scenario of owner carry to their CPA. I'm not a tax professional, but I want to make sure that you are armed with the best information. So talk to your CPA before making any decisions whatsoever. All right, so some of the benefits to you as a seller. Potentially you could get a great price for your building, or you might even be able to get a premium on the property. We saw that firsthand on our latest owner financing structure. I did a video on this earlier this year where it was a property in Costa Mesa. The seller ended up getting a great buyer, an outlier buyer that paid a premium for the real estate, fell in love with the real estate, but he couldn't make it work unless the seller carried the financing. The seller ultimately structured it. We helped him navigate through the entire process, but he was able to get a premium for his real estate, and that made it worth him to go through and not cash out and carry the financing. And now he's getting monthly cash flow checks. So you could possibly get a premium because it opens up the buyer pool to your property. We see that firsthand when we market assets with owner financing. We see a lot of buyers that are curious on what do the terms look like, and a lot of times there's some outline to what a seller is willing to take, or it's just totally negotiable, and we help kind of structure in some framework that'll help be a win-win for the seller and the buyer. And again, as a seller, you want to make sure it's a win-win for the buyer too, because you want them to be successful on the close and all throughout. You want to make sure that they run the property well, they're making money, they keep the building up to speed, and then they take you out with a loan balloon payment at the very end and pay you off. So it's really important that we really screen the buyer and vet the buyer as well. We just don't want to hand the keys to anybody. Last but not least, think about it this way. If you're carrying the financing, you have a negotiated monthly payment that the buyer needs to make to you every single month, and it's fixed. So a lot of owners that have carried the financing, they've said, Dan, we really like owner carry because you know what, the building needed a new roof here in the next couple of years. My cash flow is not lumpy with the owner, with the seller carry. I get the same monthly check. The buyer has to deal with it. Yeah, I gave up, the future appreciation on the property or future rental growth and income, but I'm getting consistent monthly checks that I can depend on. If I would have had to put the roof on the property, then I might not have cash flow for 3-4 months until I built up enough reserves to then pay out again. So I really like seller carry. I think it's great, especially if you're in a position to do so. Not everybody's going to be eligible for owner carry. If you have a big loan amount on the property, you're probably not eligible. This is for folks that really have the property paid off or a very small loan amount, because you want to look at it, the buyer, whatever the down payment the buyer is going to make, that's either going to pay off your loan, pay off the cost of the sale, and push some cash in your pocket. So if your loan amount is very large, buyer's not going to be able to do that, and they're going to go get a conventional loan in the first place. So we have an illustration here. This is simplified, but this is based off a real life example. Again, we kind of made it more simple for the video, but this is a property that we sold for $6 million. Buyer put 40% down, which is $2.4 million. The seller carried the financing at $3.6 million, and the rate that was negotiated was 5.5% for 5 years. So your monthly payment that you're going to receive as a seller is $16,500 a month. Over that 5-year period, that's $990,000 in cash flow. That's almost $1 million in cash flow. So a lot of benefits there, right? You can see that you're going to get that big balloon check at the end when the buyer then refinances, pays off the loan, or sells the property. So you've got cash coming in 3 different ways. We have the illustration here for everybody to review, very short and simple. But again, this can be negotiated even more creatively, where we saw on another transaction where a buyer negotiated with a seller the interest-only payment for the first year is 4.5%, then the second year is 5.5%, and the third year is 6.5%, because they kind of wanted to ease into the property. Then there's also a clause within that particular structure where a buyer is willing and able to pay down the property over the course of the years in case they come into some liquidity, they want to pay down the property. So we can totally customize this in a lot of different ways. All right, so moving on to vetting the buyer. This is super important. We don't want to just hand the keys over to your building to any buyer off the street. We want to make sure we know who we're dealing with. Certainly we're going to advise that you pull credit on the borrower, make sure their credit worthiness, look at their bank statements. You want to make sure that they go through a seller questionnaire checklist that we put together. Some of the things that come to mind are, you want to make sure, do they own multifamily real estate? They don't have to, but it's great to know if they have experience owning and operating multifamily real estate. It's also good if they own local to go drive by some of their buildings or all their buildings and see how they keep up their property and see if they're a good landlord. You can drive by a building and see if something's well kept or if it's run down. If it's run down, that's a red flag. So all in all, you want to make sure that you have the credit worthiness, you got some background on the buyer as much as possible. You get a personal financial statement from the buyer, so you see their liquidity, their debts. You also get a schedule of real estate owned to see how much experience they have as a real estate investor. So those are kind of the basic needs that you want to make sure that you're vetting a buyer with. And then also we can help coordinate legal counsel to structure the loan and all the other protections that you're going to need when completing this transaction. So this is, again, a process we've worked with a number of owners on. And again, it's kind of picking up popularity again because years ago, rates were so low, seller financing didn't make sense, money was so cheap, we just go to the bank and make it work. But now interest rates are higher, loan to values are compressed. Traditional lenders can only lend on the cash flow. They can't get creative. They've got a certain criteria they have to follow. So it really takes out a lot of really good buyers out of the market. And if we were to structure a little bit different loan to value and be a little bit more flexible on some things for the right buyer, you can create a great opportunity for your property on a sale. So that's it on really the benefits and illustration. It also can be great for a buyer, right? You could put maybe a little less down. The seller, it's all negotiable for the buyer too. They might be able to put, again, less down. They might be able to not have to work through all the paperwork and structure and process that a typical lender is going to do. It's going to drag things out. Maybe they need to close really quick for their 1031 exchange. Seller financing can move very, very quickly. So it's nimble. You might even, as a buyer, be able to get a below market rate. A seller might say, well, interest rate's not as important as my price. If you can pay my price, I'll work with you on the rate and the down payment. So again, it's all negotiable to really make things work. So again, no lender delays, no loan community rejections. Deals can close sooner and faster. Again, we want to make sure we vet things for you and you really do your homework before we select a buyer. So that's it. That's my final thoughts. I know that's a lot of information to unpack on a video. There's so much more I want to go through on this, but again, I'll leave it up to any one-on-ones. If anybody wants to call me, talk one-on-one about, is this a viable option? Talk more about how to structure it and really just know the value of your building. I can put a side-by-side illustration for you on a cash out with a net proceeds page. And then also here's an owner financing illustration with your cash flows for a period of time. Maybe it's 3 or 5 years. Either way, I'm here and happy to help. Thanks so much for watching, and we'll see you again soon.